Enron. The name alone feels like a time capsule from the early 2000s. You might remember the endless news segments, angry congressional hearings, reporters standing in front of a glass tower in Houston saying words like off-balance sheet vehicle as if that cleared anything up. Tonight we are rewinding the tape on the $63 billion mirage that was Enron. Not to scare you, not to predict the next crash, but to calmly walk through how one of the biggest corporate frauds in history happened while everyone from Wall Street to Washington nodded approvingly, and how, frankly, they have not learned as much as they like to pretend. Imagine a company that tells you, we don't just sell gas, we sell the future. Then you open the books and discover, actually, they sold nothing. Or at least nothing like what they claimed. That was Enron, a $63 billion innovation machine. It turned out to be a kindergarten magic trick done with PhD-level accounting. You blinked, and the rabbit, the hat, and your retirement savings were all gone. So let's take this slowly. Grab a drink, lean back. This is not a hype video, not a trading alert. This is a calm walk through the Enron scandal. How the $63 billion house of cards got built. Why it collapsed so fast. And why the phrase Wall Street learned its lesson should probably come with a laugh track. Enron's story starts in the 1980s, back when shoulder pads were big and financial regulation was less big. A guy named Kenneth Lay helps engineer a merger between two pipeline companies, Internorth and Houston Natural Gas. And out of that comes Enron. On paper, it's boring. They move natural gas through steel tubes underground. Solid, regulated, utility-style business. The sort of thing your conservative uncle used to own in his IRA and never think about. But the 80s and 90s were the age of deregulation. The idea was, free markets are magic. Competition will lower prices. Nothing bad ever happens when there's lots of money on the line. So the government starts loosening rules on energy markets. Suddenly, natural gas and electricity don't have to be sold at regulated prices. It can be traded like stocks. And Enron looks at those old steel pipes and says, pipes are fine, but trading is where the sexy money is. Enter Jeffrey Skilling. Harvard MBA consultant, the kind of guy who probably enjoyed case studies a little too much. Skilling joins Enron and pitches a shiny new vision. Enron is no longer a stodgy pipeline utility. It's going to be a high-flying energy trading firm, an asset-light, new economy player. In other words, less steel in the ground, more numbers on screens. Wall Street hears that and goes, asset-light? High growth? We love it. Where do we send the irrational exuberance? Skilling brings with him a magic word, mark-to-market accounting. Now, if you've never worked in accounting, mark-to-market sounds harmless, maybe even reasonable. In theory, it means you value things at what they're worth today in the market. In Enron's hands, it meant, we just signed a 20-year contract. And we're going to book all the projected profit today, based on our own optimistic model, and call it earnings. It's like you buying a lottery ticket and immediately recording $1 million profit in your budget because technically, it could happen. So Enron signs a long-term deal, maybe to build a power plant or provide power to a city, and instead of earning the profit slowly over 20 years like a normal company, they say, future profits? We'll take those up front, thanks. The beauty for executives is that reality doesn't matter yet. If the project later loses money, that's a future problem. Next quarter, they just sign another deal, plug in new rosy assumptions, and boom, more earnings. Meanwhile, bonuses and stock options are paid today. This game would have been bad enough on its own. But Enron's executive team didn't stop at creative optimism. They upgraded to full-blown financial cosplay. Here comes Andrew Fastow, the chief financial officer. If Skilling was the visionary selling the dream, Fastow was the guy in the basement figuring out how to hide the bodies. He created special-purpose entities, spec with friendly names like LJM and Raptors. These things were supposed to be independent partnerships that would help Enron manage risk. In reality, they were off-balance sheet dumping grounds where Enron could stuff its debts and bad bets so investors wouldn't see them. Picture it this way. You've maxed out your credit cards, but you throw them into a shoebox in your neighbor's closet and declare yourself debt-free. That was Enron's approach to transparency. On Wall Street, bless their hearts, looked at the nice, neat balance sheet and said, wow, you guys are amazing. Of another most innovative company in America trophy for years. Fortune magazine did exactly that. naming Enron America's most innovative company 6 years in a row. Analysts on television called it the future of business. Enron's stock soared to around $90 a share. If you questioned it, you were treated like a grumpy relative at Thanksgiving who doesn't get the internet. But inside the building, the culture was less brilliant. More Darwin meets high school. Skilling had something called rank and yank. Employees were constantly ranked, and the bottom chunk got fired every year. That kind of system tends to encourage exactly two things. 1, creative thinking, and 2, creative lying. If your job, your bonus, and your sense of self-worth all depend on hitting aggressive targets in a system built on make-believe accounting, you can probably guess which direction things go. Traders joked on recorded lines about burn, baby, burn during the California energy crisis, as rolling blackouts hit real people's homes. Enron effectively gamed the newly deregulated electricity market, exploiting loopholes to drive up prices. Ordinary Californians saw their bills spike and their lights go out. In Enron's office, it was just another strategy session. From a distance, it looked like sophisticated corporate finance. Up close, it looked a lot like legalized looting dressed up in spreadsheets. Still, the stock kept rising. The company claimed over $100 billion in annual revenues. To be fair, much of that was the same dollar of not quite real trading volume counted multiple times. But it sounded impressive on CNBC, which was sort of the point. Now, if you've seen videos like Enron, the $63 billion scandal explained, you already know the broad outline: rosy numbers, hidden debt, and a spectacular collapse. But it's the little human moments that really show you how fragile the whole structure was. Take Bethany McLean, a reporter at Fortune. In early 2001, she starts asking a painfully simple question. How, exactly, does Enron make its money? You'd think a $63 billion company could answer that without needing a whiteboard and 3 consultants. Instead, she gets vague explanations, buzzwords, and some hostility. When she writes an article literally titled, "Is Enron Overpriced?" Jeff Skilling reportedly doesn't handle it well. Insults an analyst on a call. Always a good look. Shouting at the one person asking, "Can you explain your business model like I'm 5?" Inside Enron, another person starts asking dangerous questions. Sharon Watkins, a vice president. She digs into some of those Fasto-designed partnerships and realizes that if the truth comes out, Enron could, in her words, implode in a wave of accounting scandals. She writes a memo to Ken Lay basically saying, "Hey, we might be a bonfire waiting for a match." Lay's response is, "Let's call it unhurried." He brings in lawyers. He brings in the auditors. Arthur Andersen, one of the biggest accounting firms in the world, and somehow no one pulls the fire alarm in time. Here's the problem when everyone's making money. Asking hard questions feels rude. Wall Street analysts were making fees from Enron. Investment banks were earning millions arranging deals. Arthur Andersen was swimming in Enron, consulting and audit fees. You don't look too closely at the golden goose. You just assume it's normal for a bird to sweat $100 bills. By mid-2001, though, the cracks start getting too big to spackle over. The tech bubble has already burst. Investor confidence has been shaken. And suddenly, those magical numbers don't glide by quite as easily. Enron announces some ugly realities: big losses, a huge reduction in shareholder equity. The market starts sniffing something rotten. Then comes the really brutal part. While executives had cashed out hundreds of millions in stock over the years, many regular employees had their retirement savings locked in Enron shares. From the outside, it looked instantaneous. The stock that was near $90 not that long before spiraled down toward pocket change. Credit rating agencies, those vigilant watchdogs of the financial system, finally downgraded Enron's debt to junk. Right around the moment everyone else realized the house was already on fire, a planned rescue merger fell apart. And on December 2, 2001, Enron declared bankruptcy, listing roughly $63 billion in assets. For context, at the time it was the largest bankruptcy in U.S. history. A company that had been the 7th largest corporation in America just vaporized. Around 20,000 employees were left in various stages of shock, anger, and how do I explain this to my family? Retirement plans were shattered. Communities that had depended on Enron for jobs and philanthropy were left picking up the pieces. The human toll was not theoretical. It was phone calls to spouses, canceled college plans, and we have to sell the house conversations. And it didn't stop with Enron. Arthur Andersen, the accounting firm that had happily signed off on Enron's creative accounting, while also collecting lucrative consulting fees, got caught shredding documents related to the audit once investigations began. That little hobby led to an obstruction of justice conviction. The firm collapsed. Roughly 85,000 employees worldwide woke up one day working for a prestigious Big Five accounting giant and ended the story as collateral damage in a scandal they didn't personally create. Executives did face consequences, at least some of them. Fasto went to prison after admitting to fraud. Skilling was convicted on multiple counts and served time. Kenley was found guilty, though he died before sentencing. There were congressional hearings, angry speeches, sound bites about corporate greed and restoring trust. New laws like the Sarbanes-Oxley Act tightened up some of the most egregious loopholes. CEOs and CFOs now had to personally certify financial statements. Audit firms had more oversight. For a while, it felt like maybe the system had looked into the mirror and decided to clean itself up. And then, well, you lived through 2008, you know what happened next? Here's where the story hits its quiet climax. Not in the courtroom, not in the bankruptcy filing, but in the pattern that repeats. Enron wasn't just about one bad company. It was about how a whole ecosystem, Wall Street auditors, regulators, credit rater, the media, even everyday investors hungry for outsized returns, created the perfect environment for reality distortion. A hot story shows up. We've reinvented energy. We've turned a boring utility into a tech-style growth stock. Analysts love it. Fund managers pile in. Everyone makes money. As long as nobody asks too many questions, doubts are treated as personal insults. You just don't understand the new paradigm. Then, eventually, math shows up like a sober friend at a wild party. The numbers don't add up, the tide goes out. And you get to see who's been swimming without a swimsuit and who took out a second mortgage to buy beachfront property. Sound familiar? It should, because a few years after Enron, you heard similar phrases about mortgage-backed securities, CDOs, sophisticated risk models, and housing prices never go down nationally. Later, you heard it about tech unicorns that somehow lost money on every transaction, but assured you they would make it up in volume. Then about crypto platforms that promised 20% risk-free yield. Different products, different jargon, same basic pattern. If you can't explain in a couple of plain sentences how a business actually earns money, you might not be investing, you might be donating. This is where the sarcasm almost writes itself. After Enron, Wall Street swore it had learned its lesson. No more blind faith, no more rubber stamping. And then, in the run-up to 2008, the same institutions happily bought and sold financial products they didn't fully understand, because the fees were good and everyone else was doing it. It's like watching someone swear off junk food while ordering just one more supersized combo, because this time, it totally doesn't count. But here's the thing. The lesson of Enron is not never trust a company. It's also not the system is rigged, give up and bury your cash in the yard. That kind of all-or-nothing thinking is emotionally satisfying, but it doesn't help you navigate reality. The more useful lesson is quieter. Systems have cycles. Human behavior repeats. Whenever there is a powerful story, we've found a way to turn boring infrastructure into limitless growth. Or we've engineered financial products that remove risk, or this time is different. That's your cue to slow down and ask simple questions. What do they actually sell? Who actually pays? Where does the cash, not the accounting earnings, come from? Who benefits if this story keeps going, and who's left holding the bag if it ends? Enron's executives gamed the rules, but the rules also enabled the game. Auditors wanted the fees. Analysts wanted access. Politicians wanted donations. Investors wanted a stock that went up and to the right forever. A lot of very smart people pretended not to see what was happening because seeing it would have been inconvenient. The comforting lie is that this was all long ago, solved by one batch of regulations, and we can move on. The more honest perspective is that Enron is just one chapter in a repeating story about optimism, greed, complexity, and the human tendency to believe what we want to believe, especially when it makes us money on paper. So where does that leave someone like you, an experienced adult, maybe with some financial scars of your own? trying to make sense of headlines that seem to alternate between greatest economy ever and imminent collapse. It starts with context. Looking back at Enron shows that sensation and panic were terrible guides at the time. When everything looked amazing, the risk was already baked in. When everything looked hopeless in the aftermath, the world did not actually end. Regulations changed. Other companies fell, new ones rose. Markets digested the pain and moved on, just like they did after 1929. After the savings and loan crisis, after 2008, after every bubble you can name, history doesn't give you a calendar of future crashes. It gives you a language to describe patterns. In Enron's case, the language is opaque business models complexity used as a shield, aggressive accounting. Cultures that reward short-term numbers at any cost, and systems where everyone along the chain gets paid as long as the music keeps playing. When you see those ingredients again, maybe in a different industry with trendier buzzwords, you don't have to panic. You don't have to predict the exact day things will break. You just have to recognize that you've heard this song before and adjust your behavior calmly. Maybe that means diversifying instead of betting on one can't-miss story stock. Maybe it means favoring businesses you can actually explain to a friend without needing a flowchart. Maybe it just means being less impressed by anything described as too complex for the average investor to understand. Translation: even we don't know what's going on, but the bonuses are great. As we wrap up this look at Enron's $63 billion disappearing act, the goal is not to leave you angry at one long-dead company. The goal is to help you see that scandal as part of a larger cycle. A cycle where storytelling, incentives, and human nature dance together, sometimes gracefully, sometimes straight off a cliff. History, especially financial history, is not a crystal ball. It's a pair of glasses. It doesn't tell you exactly what will happen next, but it helps you see the shape of what's in front of you more clearly. When you understand stories like Enron's, you're less likely to be dazzled by the next can't-fail narrative, and less likely to spiral into fear when headlines shout about the latest unprecedented crisis. Most of the time, it's very precedented, just with different logos. If you've stayed with us all the way through, so that probably means you care less about hype and more about context, memory, and clear thinking. That's exactly what this channel, Chill Financial Rewind, tries to offer: calm, historically grounded stories that make today's financial world a little less confusing, without promising magic formulas or instant answers. So if you find value in taking these kinds of slow, thoughtful walks through history, if you like the idea of looking at money markets and scandals with a cool head and a bit of dry humor, feel free to stick around, maybe subscribe, and come back when you're in the mood for more context instead of more noise. No pressure, no urgency. Just a place where we let the past talk long enough to make the present a little easier to understand.